On this slide, we're focusing on key concepts related to income-producing properties, specifically leases, rents, and the market for space. Leases are formal agreements between landlords and tenants that outline the terms and conditions for occupying a property. Rents refer to the periodic payments tenants make to landlords for the right to use that space. The space market is the broader environment where these leases and rents are negotiated, reflecting supply and demand for commercial or residential space. Understanding how these elements interact is crucial because they directly impact the income generated by properties and, ultimately, their value and investment potential. The relationship between leases, rents, and the space market forms a foundation for analyzing income-producing real estate. Income-producing properties are real estate assets that are purchased primarily to generate consistent rental income, as well as to build long-term value through lease spaces. These properties create a steady stream of revenue coming from tenant payments, which is a key advantage for investors looking for regular cash flow. However, managing these properties isn't passive. It involves leasing day-to-day operations and active management to maintain occupancy and property standards. The performance of these properties can fluctuate depending on factors like vacancy rates, market demand, and rental prices, making it crucial to stay on top of market trends and tenant relations to maximize returns. Let's talk about the three main types of income-producing properties. First, we have residential properties. These are primarily housing units, such as single-family homes or multifamily apartments, that cater to individuals and families. Residential properties usually have shorter lease terms, which means tenants tend to move more frequently, leading to higher turnover. The income comes from rent paid by these tenants. Next, we have commercial properties. This category includes office buildings, retail spaces, and mixed-use developments. The success of commercial properties often depends on their visibility and location, which can significantly affect rent prices. Leasing these spaces often involves negotiations around tenant improvements, meaning landlords and tenants agree on modifications or upgrades to fit the tenant's business needs. Finally, industrial properties cover warehouses, distribution centers, and flexible use facilities. These are typically valued based on how well they support logistics and operational efficiency. Industrial leases tend to be longer term, providing more stable occupancy and consistent income compared to residential or commercial properties. Understanding these distinctions is key when evaluating real estate investments, as each type offers different risk profiles and income potentials. When we talk about residential properties as income-producing investments, we're referring to a range of options from single-family homes to larger multifamily apartment communities. These properties generate recurring cash flow by renting out living spaces. Single-family houses typically have just one tenant, which makes management simpler. Their value and demand are highly influenced by location, so choosing the right neighborhood is crucial. Multifamily apartments, on the other hand, consist of multiple units within one property. This setup allows for economies of scale, diversifies rental income sources, and reduces the risk of vacancy since not all units are likely to be empty at the same time. Then we have condos and small residential units, often found in urban areas. These appeal strongly to renters looking for convenience and amenities, though they do come with considerations like homeowners association rules and fees. Despite their differences, all these formats share the same goal: maintaining stable occupancy and generating reliable rental income from places that people want to call home. This stability is key to successful residential income property investment. Commercial properties generate income by hosting a variety of tenants and offering different types of space tailored to specific business needs. Retail spaces, for example, depend heavily on visibility and foot traffic, making location crucial for driving sales and attracting the right tenants. Office properties are usually leased by professional users who need private suites or even entire floors and tend to commit to longer lease terms, providing more stable income. Mixed-use developments combine retail, office, and sometimes residential tenants, spreading risk by diversifying income sources and appealing to multiple markets at once. This variety in commercial assets helps create steady and diversified income streams for investors. When we talk about industrial properties, especially warehouses and distribution centers, there are several key features that make them critical in the real estate market. First, These properties are designed with functional assets like high ceilings, dock doors, and ample trailer space to facilitate efficient logistics. Their strategic locations near transport corridors increase their value by ensuring smooth movement of goods. Another important aspect is the lease structure. Industrial tenants tend to sign longer-term leases, which provides investors with stable and predictable income streams. This stability is a huge advantage in the market. From a broader perspective, these warehouses and distribution hubs form the backbone of the supply chain. They play a vital role in keeping inventory flowing seamlessly from producers all the way to customers, ensuring timely delivery and reducing bottlenecks. In summary, industrial properties are built specifically for logistics, leased to provide financial stability, and are essential assets in the movement and storage of goods. This combination makes them a valuable and reliable income-producing investment. Let's take a closer look at the three key clauses that drive income in lease agreements for income-producing properties. First, the duration and terms clause. This defines the income window with clear start and end dates, letting us know exactly how long the revenue stream will last. Renewal options can add value by extending this period beyond the initial term, but we also need to watch out for early termination and escalation clauses, which can shift risk and impact cash flow. Next is the rent and payment schedule. The base rent establishes a consistent income we can expect. Then due dates, grace periods, and penalties are crucial for managing timely collections and minimizing defaults. Rent increases may follow fixed schedules, be tied to market indexes, or adjust based on market conditions, which all affect our revenue predictability. Finally, tenant responsibilities play a significant role. Maintenance duties can influence operating costs, while insurance and utility obligations determine how expenses are allocated. Use restrictions protect the property and ensure that other tenants aren't adversely affected, which is essential for maintaining property value and stable income. Together, these three clauses form the backbone of lease agreements, shaping the income potential and risk profile of an income-producing property. Understanding them thoroughly is key to effective property management and investment success. Here we have a comparison between gross leases and net leases, two common types of leases used in income-producing properties. Starting with gross leases. In this setup, the landlord is responsible for most of the operating costs. That means the tenant pays one set rent amount, and the landlord absorbs property taxes, building insurance, common area maintenance, repairs, and often utilities or janitorial services in multi-tenant spaces. These expenses are typically included in the rent, making it simple for the tenant because they don't have to worry about fluctuating costs. On the other hand, with net leases, the tenant takes on more of the expense risk. Here, the tenant pays a base rent plus some or all of the operating costs, which reduces the expense burden for the landlord. Net leases come in different forms. Single net leases require the tenant to pay property taxes. Double net leases add insurance costs to that, and triple net leases include maintenance as well. In this case, the tenant is responsible for those specific expenses. Understanding these differences is crucial because they affect the financial responsibilities and risk distribution between landlords and tenants, which can impact cash flow and budgeting for both parties. Let's walk through the lease negotiation process step by step. It begins with the initial inquiry, where the tenant's interests, space needs, and timing are clearly established. This helps both parties understand the basic requirements right from the start. Next comes the offer submission, where a formal proposal outlines key details like rent, lease term, any improvements to be made, and possible concessions. After this, we move into the counteroffer stage. Here, both the landlord and tenant work together to refine financial terms, responsibilities, and any flexible provisions that could better serve both sides. Once there's a tentative agreement, due diligence takes place. This involves a thorough financial review, legal checks, and verifying that the lease language is accurate and fair. Finally, the execution phase converts all of these negotiated terms into a legally binding lease with signatures. This structured approach ensures clarity and protects the interests of everyone involved, especially when dealing with income-producing properties. Here we see how to calculate the effective annual rent for an income-producing property. The basic income formula starts with a monthly rent multiplied by 12, which in this example is $2,500 times 12, totaling $30,000. However, we need to account for vacancy loss, which is a potential income loss when the property is not rented. Assuming a 5% vacancy rate, that translates to a $1,500 reduction. Subtracting this vacancy loss, the effective annual rent comes to $28,500. Now, improving this effective rent is key to maximizing income. First, conduct a thorough market analysis. This means pricing your rental based on real demand data, rather than just instinct or guesswork, ensuring you set competitive yet profitable rent levels. Second, tenant screening is essential. By carefully selecting tenants, you reduce the risk of defaults and costly turnovers, which helps maintain consistent income. Third, regular property maintenance is crucial. Keeping the property in good condition not only protects occupancy rates, but also justifies rent increases over time. These strategies together help optimize your rental income effectively. Here, we're looking at the market dynamics that influence rent cycles in income-producing properties. Rent levels tend to move through four predictable phases: growth, peak, decline, and recovery. During the growth phase, strong demand outpaces available space, pushing rents upward. This is when landlords can increase pricing because competition among tenants is high. As the market reaches the peak phase, rent growth slows and signals limited upside. The market is balanced or nearly full, so there isn't much room left to increase rents further. Following this, we enter the decline phase, where we see rising vacancies or an influx of new supply. This puts downward pressure on rents as landlords compete to fill available units, testing overall occupancy. Finally, we reach the recovery phase, where vacancies begin to decline as tenant demand improves and absorption of new supply resets the market momentum. At this stage, rents stabilize and start to recover, setting the stage for the next growth phase. Understanding these cycles is crucial for timing investments and managing income-producing properties effectively. Here, we're focusing on vacancy and tenant retention, two critical factors that directly impact the financial health of income-producing properties. First, let's look at vacancy rates. Even a small vacancy rate, say around 5%, means unleased space that results in lost rental income and ultimately weakens your net operating income. When vacancy rates reach between 8 to 10%, the impact on NOI becomes even more significant because fixed costs like maintenance and utilities still need to be paid, regardless of whether the space is leased. Now, let's talk about tenant retention. Renewing an existing tenant can be 4 to 6 times less expensive than finding a new one, which makes retention efforts highly cost-effective. Key drivers for keeping tenants happy and renewing their leases include providing excellent service, maintaining clear and consistent communication, and offering fair renewal terms. Reducing tenant turnover not only cuts down on downtime and leasing expenses, but also minimizes concessions you might have to offer to attract new tenants. Plus, a stable tenant base leads to more predictable cash flow, which is crucial for managing income-producing properties effectively. Overall, focusing on these areas helps maintain steady income and control operating costs. When we talk about value in real estate, location really is the primary driver. The highest rents and lowest vacancies typically come down to where a property is located, not just what kind of property it is. Transit plays a big role here. Properties close to stations, highways, and walkable corridors tend to attract more demand. Being accessible makes a property more desirable for tenants. Demographics also matter a lot. The income levels, household growth, and overall spending power in an area shape the quality of tenants interested in the property. Zoning is another key factor. The types of uses permitted and any future development rights can create potential for increased value by unlocking new opportunities for the property. Competition in the neighborhood is important too. The amount of nearby supply affects pricing power, how quickly units get absorbed, and leverage for renewing leases. Ultimately, value follows demand. Great locations attract tenants first, and capital tend to follow closely behind, driving income-producing properties to perform well. When financing income-producing properties, there are 4 key numbers that shape the deal before the asset ever starts to perform. First is the down payment. Investment loans often require more equity upfront compared to owner-occupied financing, so a larger initial cash investment is typically necessary. Next Loan terms and rates play a crucial role. Factors like amortization period, whether the debt is fixed or variable, and the interest rate itself will influence the monthly costs as well as the risk associated with refinancing down the line. Then we have the debt service coverage ratio, or DSCR. This ratio is essential because it tests whether the property's income comfortably covers the required loan payments. Lenders use this metric to assess stability and reduce their risk. Finally, investment returns are evaluated through different measures. The capitalization rate, or cap rate, gives a sense of the yield on the property's value, while the cash-on-cash return reflects the yield on the equity invested. It's important to remember that lenders primarily underwrite for stability, focusing on consistent income, whereas investors are more concerned with the upside potential and returns. These four numbers collectively determine whether the financing deal is viable and sustainable. The cap rate is a crucial metric because it quickly shows how efficiently a property converts its value into income. This makes it one of the fastest and most effective ways to compare different investment opportunities across various markets and property types. To calculate the cap rate, you take the net operating income, which is the income generated by the property after expenses, and divide it by the property's total value. For example, if a property has a net operating income of $120,000 and is valued at $2 million, the cap rate would be 6%. This percentage gives you a clear picture of the property's income potential relative to its value, helping you make smarter investment decisions. Understanding the cap rate is essential when evaluating income-producing properties. When we talk about strong cash flow, it's important to remember that it starts with controlling expenses, not just raising rent. The basic formula here is pretty straightforward. You take your gross rental income, which is the total revenue from renting out your property, then subtract the operating expenses to arrive at the net operating income. Operating expenses include things like property taxes, insurance, maintenance, utilities, and management fees. These costs are significant because they reduce the income actually available to the owner, and they play a direct role in shaping the overall value of the property. So, managing these expenses effectively is crucial for maximizing the profitability and value of income-producing properties. When investing in income-producing properties, it's crucial to understand and manage 5 key risk factors that can significantly impact your returns. First, tenant risk. Issues like late payments, defaults, or early move-outs can disrupt your income stream. Poor tenant quality often leads to higher turnover and increased collection costs, which eat into your profits. Next is market risk. An oversupply of properties, weaker demand, or an economic downturn can drive rents down and vacancies up, affecting even well-located assets in a struggling submarket. Third, property condition risk. Delayed maintenance, aging systems, and unexpected repairs can quickly diminish cash flow. Often, capital expenditures end up costing more than initially anticipated. Fourth, regulatory risk involves changes in zoning laws, rent controls, building codes, or new compliance requirements. These can restrict your revenue potential and raise operating expenses. So staying informed about local policies is essential. Finally, financing risk comes into play with higher interest rates, stricter lending standards, or difficulties in refinancing. Leverage can amplify both gains and losses, making this risk especially important to monitor. Ultimately, your returns rely on how effectively you price, prevent, and manage these 5 risks throughout your investment. Here, we're looking at the impact of rising interest rates on income-producing properties. When borrowing becomes more expensive, it affects several key financial factors. In a low-rate environment, debt is cheap, with loan pricing around 4% and cap rates at about 5%. This means more buyers can afford to make deals because financing costs are lower, supporting stronger property values. Lower debt costs not only help maintain pricing, but also enhance leverage returns, generating better after-debt cash flow. However, in a high-rate environment, loan pricing jumps to around 7%, and market cap rates rise to about 6.5%. This leads to a tighter market where property values decline if the net operating income, or NOI, stays the same. Owners face pressure to boost rents or improve operations to offset the higher cost of debt, or else property values and cash flow will suffer. Ultimately, rising interest rates put upward pressure on borrowing costs and cap rates, which can reduce property values unless income growth keeps pace. It's a crucial dynamic for investors to monitor in today's market. Tenant screening and due diligence are crucial steps in managing income-producing properties effectively. The goal here is to protect your cash flow even before the lease is signed. It's not enough to just glance at the application. You need to verify the tenant through multiple checks. This includes looking into their credit history to understand their financial habits, employment verification to ensure stable income, and rental history to see their track record with previous landlords. Reference checks add another layer of insight, helping you assess their reliability and character. By following a disciplined review process, you lower the risk of defaults and improve the quality of your tenants, which ultimately supports long-term occupancy and steady income. Let's talk about the tax implications for property owners, especially those with income-producing properties. First, depreciation deductions are a key consideration. The value of the building can be depreciated over its useful life, which means you could deduct a portion of that value each year to reduce your taxable income. However, it's important to note that land itself is not depreciable. Next, operating expenses and write-offs are another important area. Common deductible expenses include interest on loans, repairs, insurance, utilities, and management fees. Additionally, costs like travel related to property, legal fees, and advertising expenses may also qualify as deductions. Keep in mind, though, that capital improvements to the property typically cannot be immediately expensed. They need to be capitalized and depreciated over time. When you eventually sell the property, capital gains considerations come into play. The profit from the sale might trigger capital gains tax. Also, any depreciation you've taken in the past may be subject to depreciation recapture, which means it can be taxed at a different rate. One way to defer taxes when selling is through a 1031 exchange, which allows you to reinvest the proceeds into a like-kind property, provided you follow specific IRS rules. Together, understanding these points can help property owners make informed decisions to optimize their tax benefits and plan for potential expenses down the road. Here we see a focus on emerging market trends and the opportunities they bring. First, remote work impact is transforming how and where business value is created as more companies adapt to flexible work environments. Second, ESG demands, environmental, social, and governance factors, are increasingly influencing investment decisions, emphasizing sustainability and ethical practices. Third, industrial automation is driving efficiency and innovation in manufacturing and production, opening new avenues for growth. Finally, experiential retail is reshaping consumer experience, blending physical and digital interactions to attract and retain customers. All these trends are shifting the landscape of income-producing properties, highlighting where new value is emerging in the market. When building a diversified portfolio, it's important to blend property type allocation with strategy that spreads income across various markets, tenants, and risk profiles. This approach helps balance stability with growth potential. For example, in terms of property types, a common allocation might be 45% residential, 35% commercial, and 20% industrial properties. Residential properties offer stable occupancy and broad renter demand, making them a solid foundation. Commercial properties tend to provide higher income potential, though they come with more cyclical exposure. Industrial properties, especially those tied to logistics, benefit from long-term leases and growth driven by supply chain trends. Diversifying across these sectors, along with geographic diversification and a varied tenant mix, aligns with different risk tolerance levels and helps create a resilient, income-producing portfolio. Here's a case study of a successful property investment involving a 12-unit mixed-use asset. This property added significant value through a strategic lease-up, light renovations, and disciplined operational management. The property type is mixed use with 12 units, acquired for $2.4 million and generating a current monthly rent of $22,000. What made this investment work so well? First, it was purchased below replacement costs in a highly walkable submarket, which provided a strong foundation for growth. Second, occupancy was increased significantly from 78% to 96% by focusing on targeted lease-up efforts. And third, the net operating income improved through facade upgrades and more rigorous expense management. Looking at the return metrics, The investment achieved an impressive 18.6% levered internal rate of return over 4 years and a 9.4% cash-on-cash return. Additionally, the property saw a 31% value gain during that time. Currently, there are 23 income-producing properties in this portfolio, highlighting a successful, repeatable approach to value creation in real estate. As we wrap up, let's review the 6 essential takeaways for mastering the income property market. First, the lease structure is crucial because it directly influences income stability. Understanding how leases affect cash flow helps you plan better. Second, optimizing rent involves balancing pricing, occupancy rates, and lease renewals to maximize returns. Third, market timing is key. Rents, vacancies, and overall returns can vary significantly depending on when you enter or exit the market. Fourth, your financing strategy needs to align with your holding plan to ensure you maintain flexibility and financial health. Fifth, managing risk effectively is vital. This means diversifying tenants, controlling costs, and maintaining steady cash flow. Finally, diversification across property types, tenants, and markets helps protect your investment against downturns. Keeping these essentials in mind will put you in a strong position to succeed in income property investing. Now that we've covered the fundamentals, let's talk about the next steps in evaluating your first property. The very first thing you want to do is define your return goals. Knowing what kind of return you're aiming for will help guide your entire decision-making process. Next, it's important to target the right market. Each market has its own dynamics, so finding one that aligns with your investment strategy is crucial. Once you know where you want to invest, you need to underwrite the rents and expenses. This means carefully analyzing the income the property generates against all the operating costs to ensure the numbers make sense. Then, review the leases and tenant quality. Stable, reliable tenants can make a big difference in your investment success. Finally, it's essential to walk the asset with your advisors. This is where you move from theory to reality, confirming all your assumptions on site. Visiting the property in person can reveal insights that you won't see on paper. Taking these steps seriously sets a strong foundation for evaluating any income-producing property effectively. As we wrap up, I want to highlight some essential resources for further learning and ongoing reference. These tools and organizations are incredibly valuable for research, benchmarking, and evaluating deals in real estate. First, consider the key books and publications, like the IREM Income Property Textbook, which offers foundational knowledge on income-producing properties. Market reports from PwC and the Urban Land Institute provide insightful data and trends. Professional associations such as the CCIM Institute, Urban Land Institute, and IREM are excellent networks for continued education and industry standards. Next, online tools and databases like CoStar and LoopNet give you access to leasing comparables, vacancy rates, active listings, and asking rents. Additionally, Census and Bureau of Labor Statistics data can help you understand demographic and employment trends crucial for market analysis. Finally, don't overlook advisory services. Commercial brokers, property managers, real estate attorneys, and CPAs can offer expert advice to navigate complex transactions and ensure sound investment decisions. Using these resources regularly will strengthen your expertise and keep you ahead of emerging trends in real estate.